Good afternoon, ladies and gentlemen. Welcome to Business Today Television. This is Shail Bhatnagar, and with me is Sakshi Batra. The warmest and the most wonderful festive greetings to you all on Dhanteras, as also on impending Diwali. We have a cracker of a panel here today for understanding where markets are headed and where resides value in this wonderful bull market that we are unfolding in front of us. Today we have Gautam Trivedi, co-founder and managing partner of Nepean Capital with us. This is a company that deals both in private and public market. Of course, Mr. Atul Suri is a well-known face. He is the CEO of a very well-known technical advisory company called Marathon Trends, and perhaps the most aggressive PMS fund manager on the Lal Street, Mr. Nilesh Shah, also joins us to discuss where markets are headed. Welcome, gentlemen, and our best wishes to you on this festive season. Sakshi and I will be throwing you very, very difficult questions, which you have to answer to us in very simple language. I'll start with Gautam because he's just made a trip to the US and spoken to a lot of funds on the institutional side, met up all with his friends ahead of Christmas, and he's bought this Christmas cheer on Diwali as well. Gautam, what have been your interactions with these deep pockets, and what are they telling you about India?
Yeah, so I think, first of all, I don't know if I'm bringing Christmas cheer, but I'm bringing a dose of realism, I think, to the Indian equity markets. I think that's probably a better way to explain it. I wish I was bringing more cheer. But I was there for about 12 days, and I met a whole cross-section of institutional investors, also attended an investor conference in New York. And what I found is that earlier last year, as well as early this year, a lot of the financial pundits had indicated that, had indicated that there would be a recession, and a major recession starting in the US, impacting the rest of the world. But frankly, we are 10 months into 2023 and it yet hasn't happened. So even now on this very visit, I met a bunch of people who still believe that a recession is probable in the first quarter of the coming calendar year, i.e. First quarter calendar 24. And having said that, a lot of them have trimmed down the probability of a recession. So somebody who was at 50%, for example, Mark Zandi, who's Moody Analytics chief economist, he's reduced his estimate from 50% to 33%. But a lot of people are still pounding the table that there will be some sort of a recession. I just hope it's not going to be a very deep recession. It, hopefully ends up being a shallow recession. But the fact is, so that was point number one. The second point, which I came back with, was the highest level of interest that I've seen in India in my life, in my working life, should I say. And again, a lot of that is at the expense of China. So the interest is there, but the problem I found is that the ability to incrementally invest more money into India at this point of time, unfortunately, seems to be limited given the high valuations. And I said this recently as well, that we are still, whether we like it or not, the most expensive large equity market in the world. At 20 times a calendar 24 PE, we are now 115% at 115% premium to China, which is at 9.3 times. And we are at least at a 12 to 13% premium to the S&P 500 itself. So if you look at the selling that's come in the last over 2 months, we've seen about $5.4 billion of FPI selling in India. So, do understand where they're coming from. They find India expensive. And if their home country alone in the United States is trading at a discount to Nifty, I guess at some point they'll say, why take currency risk? Why take some of the other issues which the average emerging market has, and let's conserve capital and invest it back home. So I think that's where it's coming from.
That's wonderfully said, Mr. Trivedi. Thanks for setting that context right. Mr. Suri, I'll begin with you now to carry forward from where Mr. Trivedi has left off. Do you also believe, in the last 1 year or so, it's the domestic institutional investors who've been the real heroes, propping the markets up. Do you think that will continue, even if the FII flows stay limited, just like how Mr. Trivedi pointed out? And how do you see the entire next year to pan out?
I think the trend that we are seeing in domestic flows, which is around, say, we are seeing 2.5 to 3 billion that is coming in. is offsetting the FI flows. And all my life, I remember the thing we have looked for every evening was the FI figure. Now it's weeks when I don't even check FI figures because irrespective of what FI flows are, our markets do our own thing. And I think that's a beautiful space to be in, first and foremost. And this money is sticky. It's not that, I noticed that even I run a PMS, so we have client reactions. Earlier, each time market would correct 5 or 10%, people get very skittish. I mean, no one would have the courage to really top up and, add to that. But I think that the behavior has changed a lot. And I think that this shift is a basic mindset shift. It's the whole demographic story, which is really playing out through the way equity investors are. I think the year that is there has two variables which I would look out for. First, obviously, is the US Fed, because whether you like it or not, that they determine interest rates, which is definitely a very, very big influence on equity markets and the larger flows that there are, global sentiment, which is, of course, important. You can never ignore it. And second, I think, is that we have a lot of elections. And this tends to have a lot of local flavor. State elections are fine, you can interpret it in various ways, but obviously the central elections, which is come May, is very, very important. And the fact is that the market is kind of believing continuity. And obviously, as we get nearer to that, there will be a lot of poll pundits. But I think that that is one area that is a event that is 6 months away, which for me could be a basis of volatility. As I said, in the long run, we've done a lot of work and we can discuss that in detail. That in the long run, investors in the past have made money in election years. However, I feel that these two things, the global trend influenced by Fed policy, and second is domestically, the central elections are going to be a bit of cause for volatility.
Okay, so the mood and the theatre has been set for Nilesh Shah. Gautam Bhai says that we are a bit overpriced relative to the rest of the world, and Atulji is a bit concerned about how the elections and the resulting volatility will impact prices. Nilesh Bhai, to you. You are the practitioner in terms of picking stocks and one of the finest brains that I have come across on Dalal Street. Now, how are you investing the fresh money that is coming into your PMS Envision Capital on a regular basis? Where do you find value and where are pockets of pain that you see emerging on Dalal Street?
Well, Shell, so that's a great question, a very interesting question. I think on an incremental basis, I think we are liking some of the large caps. And I believe clearly that that should essentially be a good place to be in if there were to be more volatility or if there were to essentially be any adverse outcomes of any of the important events. So I clearly believe incrementally, it's not that we're putting all the money to work in terms of large caps only, but clearly there's now a bias going towards the large caps. And as I see essentially, your screen, I mean, the bank Nifty's underperformed for the last 1 year. And it's quite possible that some of the larger private banks which have underperformed or not given any returns for the last 3 years or so, actually that might be a good place to kind of be in on an incremental basis. So clearly it's a bit shift towards the large caps, which we are doing. Two is businesses which have essentially not done as well, but stock prices have done very well. We're kind of using this opportunity to maybe exit some of them. So that's the second kind of action that we are implementing. And the third is to kind of continuously be incrementally more positive and find businesses which are riding the wave of digitalization. I think digitalization is going to be is already a very powerful phenomena, cutting across financials, consumer space, B2B, e-commerce, a whole range of sectors of businesses which are kind of riding the wave of digitalization. And I believe that probably from a multi-year, multi-decade perspective, that might be a very, very powerful theme. And it's quite possible that if we see some more volatility in global markets, you could actually see that volatility getting kind of echoed here as well back, which again is going to create the opportunity. So these are some of the kind of tweaks that we are doing with our portfolio strategy.
Right. And it's perfectly in sync with reality. You've seen Samvat to Samvat returns on the mid cap and the small cap index. They've exceeded 25%, although the Nifty is just up 10%. So relative value in blue chips, and of course, profit booking is the way forward. We've seen many stocks go up 4x, 5x, and that's how Nilesh is looking at his Envision Capital's portfolio. Nilesh, what bothers you in this kind of a market? Of course, we've had this wonderful Goldilocks scenario where everything and anything that could go possibly right in India has over the last 6 months to 1 year. You've talked about the digitization theme in detail, but what is it that keeps you awake at night, which might result in a 5-7% cut on the main index, and that probably will be a buying opportunity? But what is that pain point?
I honestly don't think a 5 to 7% kind of a cut will honestly bother, because that's something which over a period of time, all of us have learned to take it in our stride. Volatility is going to be there, especially after such a great year. The probability of volatilities and a higher volatility only increases. It's always, while we can keep discussing about some of the macro risks in terms of liquidity, crude oil prices, geopolitical risks, election outcomes, these are yes, the headline risks, but ultimately I think as portfolio managers and investors, what bothers us the most is essentially any execution challenges which any of the portfolio companies may face. That is honestly the single biggest factor which worries. And two is, off late, especially in the capex space, we're seeing increasingly companies wanting to raise capital. They need capital, but I just hope that that once you raise capital, the capital allocation happens in a very prudent and a responsible manner. So that's the other area which kind of worries you a bit. But otherwise, I think beyond that, I don't think we're too worried about any of the other things. We can potentially talk about if the Israel Palestine crisis escalates further or it keeps elongating. But these are things about which you can't do much about.
Okay. Mr. Suri, let me come to you with respect to understanding where are you looking for, mega trends perhaps for the new Samvat? Any particular sectors that you're going big on for the new year?
So we've been fairly overweight in the whole capital goods infra engineering space, and the last year has been very good because at a headline number, the Nifty is up some 5 to 10%. So it's not really been much on the Nifty per se, and a lot of these stocks which are in this space, which is cap goods infra engineering, have done very well. I mean, they're up a few 100%, some of them. And again, it's a lot of people have a concern that there is a bubble in the small and mid cap space, but I think that we are seeing with the quarterly numbers that some of these companies are delivering very impressive numbers. So if one is selective, I still think that there is a lot more juice left in the small and mid cap space, because most people are looking at small and mid caps in the last 6 months or thereabouts. But you must realize that if you look at the longer term, I mean, even if you take in last year maybe the Nifty was up 3-4%, but the small and mid cap was off 15-16%. So it's not that it is an absolute bubble territory. We do think that there are a lot of opportunities still in the mid and small cap case space. We like the domestic facing engineering infra cap goods kind of space. We are actually overweight in this space, and we are underweight in the more popular sectors and themes, which is the large private sector banks. We are also underweight large IT stocks. We like mid-cap IT. We think there are some real gems out there. We like healthcare, apart from pharma, which is very interesting. But still, as far as we are concerned, a large, big, overweight bet continues to be capital goods, engineering, infra, because we really get a sense that the capex cycle is reviving, and these companies have done well in the last year. Wherever they are executing well, wherever the numbers that are coming out are good, I think I have a lot more opportunity, because I remember that very often when stocks move, we think, oh, this just run up, it's a bubble, etc. But if you've experienced 2003 to 2008, you realize that a lot of these stocks can move many times more, and it tends to be elongated. So we get a sense that we could be in that sort of a phase.
Right. And it seems that the fabulous rally that we saw from the early part of 2004 to 2008 is now getting replicated on Indian capital markets. Coming to you, Gautam, you've started on a very somber note. Yet I look at Nepean Capital's website and I see stocks being talked about like Spandana Sphurti. You've made a fairly detailed comment on HDFC Bank, why it's likely to underperform. How are you deploying your funds? Are you more in cash? Of course, you are a bit worried about where the valuations are. But in India, as we've often realized, that things that are good get better, and better gets expensive and expensive. How are you deploying your money these days?
Well, I did start on a somber note, but the somber note was more to do with foreign flows. It's not so much somber on the Indian economy or the domestic flows. And I think the somber mood is where, which is fresh off the press from my US trip, based on the investors that I did meet and interacted with. So I think the domestic side of things, I think, are still very, very strong. And I think Atul alluded to the flows which are coming in. The reality is that on the domestic fund side, the flows that are coming into the domestic mutual funds, into AIFs, into PMSs, which Atul, Nilesh, and I manage, I think what we're seeing there is that the appetite for India, yes, there is concern from certain quarters about the valuations, even domestically, but the appetite for India from the market as a whole is still underpenetrated. And if you look at Angel One, which is gives a very good report on where the incremental flows are coming from. So if you see the latest monthly data which came out, 89% of the incremental broking accounts, which is what the business that they're in, incremental broking accounts are coming from tier 2, tier 3, and beyond towns. So the equity culture clearly is expanding. And what we are seeing on the SIP front is in month by month increase in the absolute amount of money that's coming into SIPs. And that's clearly caused by a whole bunch of factors, which includes, people having access to smartphones, a 4G network, eKYC, discount brokerages. So I think that momentum of money coming into the Indian equity markets from domestic investors, and as Atul said, frankly, is it that relevant to see offshore and FPI money on a daily basis? It's probably not, because if you think the market did nothing great on a certain day or marginally went down, you're not really that concerned, because there was even if the FPIs did sell, it was offset by strong domestic money coming in. So I think that's on the fund flow side. So I'm still pretty positive about the underpenetration of the Indian equity markets and how that may still have a lot of room to increase. On going forward, one of the sectors that we've been pretty bullish on and we like is the EMS space. My personal belief is that the EMS space, that sector is where the Indian IT sector was 25 years ago. And we are seeing the birth of a whole new sectors. I would say there are so many new sectors that either were dormant or have now been, that have now come about in the Indian equity markets in the last 3 to 4 years. Railways and defense being two others. A lot of these companies were not listed, and now they're listed, and see the performance has been spectacular. Now, specifically on EMS, I'd like to say that the two poster childs of this industry were Dixon Technologies and Amber. Now, they are in a very different business. They're more assemblers and great companies, fantastic top line growth. But margins have been about 3 to 3.5% in terms of EBITDA margins. Now, if you look at the newer companies that have got listed, so you now have 9 companies that are listed. I believe there are about another 5 or 6 EMS companies that will soon list. But companies that are in the value-added segment, like RFIDs, printed circuit boards, they're making anywhere from 9.5 to 10.5, 11% EBITDA margins. So my view is that this is a sunrise industry in India, and this is an area that investors should certainly be tracking.
Okay. Mr. Shah, let me come to you. I wanted to take particularly your outlook on the mid-cap space for the new Samvat. We have seen the space outperform, especially when we talk about specific pockets like mid-cap IT. I wanted to understand what explains the dichotomy that we've seen, underperformance of the large-cap IT firms, but the outperformance of the mid-cap IT firms. They face the same kind of headwinds, they cater to the same kind of clients. Why is it that the mid-cap IT firms have been able to outperform and large caps have not been?
It's clearly the power of specialization, the power of focus, the power of capabilities. The large companies essentially have now become behemoths. It's pretty much like when you look at the consumer space and we see DHULs, Britannias at best growing in like kind of mid-single digits. It's not a bad growth rate, but it's because they're catering to markets which are more mature. Similarly, the larger banks have been growing at a lower pace versus some of the specialized players. Something similar is also playing out in the technology services space, where the large companies are struggling to essentially grow at a higher pace. Even if they're addressing emerging technologies, those emerging technologies will probably contribute 1%, 2%, 5% of their revenues, which doesn't add much in terms of the growth rate. Versus that, if there is a tier 2, tier 3 company or a mid or a small company in the IT services space, because it's able to kind of be agile and fleet footed and adopt new technologies and implement new technologies for their clients, that kind of an opportunity really contributes quite significantly to your growth rates. And the underlying parameters are almost pretty much the same, which is basically high teens of margins, and capital efficiency, which is north of 20-25%. So I think once you have the basics of good margins and high capital efficiency, and if you can essentially top it up with exceptional growth rates or high growth rates, I think the market is surely gravitating towards that. And that's what is happening. I think look at some of the new opportunities emerging, especially in terms of the software defined vehicles. That's an interesting space. The whole shift towards SaaS, the whole emergence of fintechs globally, or consumer companies continuously trying to improve the user interface and the user experiences. These are all great opportunities, which may not mean much for the very large companies in IT services, but it means a lot for some of the smaller companies. And so clearly the power of focus, specialization is really helping these companies.
Right. Nilesh, we've asked this question to a whole host of mid-cap IT companies over the last 2 quarters, and perhaps the most sensible and practical answer has come from you, because you watch the sector from a height of 35,000 feet. Let's drill this a little further. We've seen this fantastic rally coming in the small cap space. Atul has alluded to it, and in terms of being a bit circumspect, Gautam of course has mentioned that there have been runaway rallies here. You as a PMS fund manager, when you sit with your analyst team every morning and you look at the small cap space, what comes to your mind initially, and how are you navigating this?
So Shil, the best way to deal with situations like this, and not just in this situation, but continue to keep doing is the execution sustaining? Over a period of time, I think the biggest learning has been that as long as there is high growth and sustained capital efficiency and good capital allocation, you don't worry too much about stock prices, and the markets can keep surprising you, because this holy trinity of high growth, good capital efficiency, and prudent capital allocation, this combination of three, as long as this combination prevails, multiples and valuations and stock prices don't really matter too much, unless of course there are valuations which really go into the bubble zone. That's a very different discussion. But clearly, I think on a daily basis, the single thing to really kind of focus on is essentially the growth rates, capital efficiency, and capital allocation.
Okay. Mr. Trivedi, I'd come to you now. You've talked about the spaces that you'd be positive on. I want you to tell us and all our viewers, where should one really stay clear from in Samvat 2080? Is there any particular sector or sectors where you would like them to avoid?
I think the metal space is something which, if the recession in the US, even if it is shallow, will end up certainly impacting cyclicals, and metals in particular, I think would be an industry that will take a hit. It'd be a positive, of course, globally. If metal prices go down, it'd be positive for our country, because we are very much in a very strong investment phase, urbanization phase, and both of these are very material intensive. So that should be good news for us. But I think that's an area I would certainly stay away from at this point.
All right. And I'll take, Sakshi, the final question with your permission to Atul. Since Atul, you are the closest compared with anyone of us to charts, I'd just like you to help us chart a 2.5, 3-year trajectory of the Nifty, given the SIPs that are coming in, given the interest from ultra HNIs, and the fact that everybody and his mother now want to participate in this rally that's unfolding on Dalal Street. What are the charts telling you specifically on the Nifty?
See, giving targets, etc., on that time frame is a little difficult because things tend to be dynamic. But what I'm observing, or global markets are very dynamic. I mean, who could predict something happening with Hamas, Israel? So a lot is going to happen. Fed, blah blah blah. There's a lot going to happen, right? Clearly, our life is never going to be boring. It's always going to be exciting, and always unexpected things are going to happen. So what I really see playing out in the market, and in a case in point, is what's happened in the last 2 months, right? You had this whole Israel whatever stuff happening. You will notice that India definitely will be in sync with global markets. You cannot diverge for a long period of time by a great percentage. But typically, what I'm noticing is that whenever markets correct, even India corrects less. And when the markets bounce up, India is the first market to make lifetime highs. So there's a lot of difference. Like I'll tell you, in the last 2 months, the US, the S&P has fallen about 11%. India has just fallen 7%. One. Number two is that as and when the recovery happens, India is just some 3 to 4% from lifetime highs. So what you will see is that we cannot be totally uncorrelated with global markets. Yes, we will stay with the larger theme and trends that are going to play out. That's why bond yields, Fed, etc., will be important. But in whatever the dance that there is in the next few years, the important part is that India falls less. And as and when markets recover, you are going to remember that India is the market touching lifetime highs. See, lifetime highs 50 is a very different from 52-week highs. A lot of markets, are struggling at 52-week highs. They're nowhere near their lifetime highs. But India is one market which most consistently is making lifetime highs over an elongated period of time. So typically, India will show the characteristics of a leader, which is hopefully will fall less when markets fall, and this is obviously driven thanks to the retail money, which comes in at lower levels and gives a bit of a base. And more important is when market turns. We've been talking about this 2-3 billion that is coming into India, and there is a substantial amount of FI money flowing out of India. Just assume that if this domestic money continues to come in, at some point in time, the FIs, due to whatever reasons, will come in to buy. Then what is going to be the reaction on of our market? So per se, as I said, we will dance with the global markets, but definitely will be the best dancer that there is. And that for me as an investor, where we are invested in equity for long terms, I think for me that is good enough because I know that I am with the trend. And I think globally equities, the trend is with India.
Wow, wonderfully said, sir. Mr. Trivedi, I'll come to you now. For an absolutely, say, first-time investor wanting to invest, say, about 10 lakh rupees in the market, how would you advise them to create a portfolio this Diwali in terms of asset allocation and even in equities? If you could just give a breakup to get a big, better clarity on this.
Yeah, I think the one thing before I even answer that question, and again, assuming this is going to go to a wider audience of investors, is that for heaven's sake, do not work on tips. A lot of information, I would say, the amount of information that's available for free on the internet today, if you want to really fold up your sleeves and do research on a company, is in abundance. So the fact is, when I meet people socially, they say, "Kya lena chahiye? What's the hot stock?" And I said, there is no hot stock. If I recommend a company to you, you must go and do your own homework and make your own final decision. So that's my advice to anybody and everybody that I talk to. But having said that, I think from an asset allocation standpoint, here's the thing. I would have thought earlier this year or even in the middle of this year, as interest rates kept climbing and the RBI was keeping more or less in step with the Fed, that a higher level of interest rate would actually dissuade people from putting incrementally more money to work in the equity markets, but that's clearly not happening. So even when you have AAA bonds, giving you a yield of 7.5 to just over 8% pre-tax, you still are seeing the money flow into equity markets continuing at a higher pace. So my view would be, from an asset allocation perspective, I would certainly also look at real estate if you end up being a real user or want to make or also want to be an investor. So I think allocating, again, I'm not very good with these numbers, but I'm just throwing a number out. I'd say about 2/3 of your 60 to 65% in equities, about 20 to 25% in fixed income, and the balance in real estate. That's the way I put it. And of course, I would add a little bit for gold, again, depending on your wife or your better half, who may or may not have a different view.
Right. And in the case of Sakshi, she's the decision maker when it comes to buying gold and buying more gold. But we'll have to add a couple of zeros also to 10 lakh rupees if you wish to take a pie out of the real estate market, especially in an area where all our three guests are based. But that's the,
REITs. We'll go with REITs.
We'll go with it. Okay. Nilesh bhai, the final question comes to you. And it is about crystal gazing, which is that look at 3 or 4 years ahead for us. Should the present political dispensation come back to the center of power in May 2024, somewhere like 27, 28, May 27, May 28, where do you see the markets? How do you see the Indian economy's dynamics changing? You've talked about a very major trend, which is digitization running across economics, running across sectors. Where do you see India 4 years from now?
Well, probably that's going to be the most interesting and the most powerful development. Clearly, our view is, and I'll take on from what Gautam said initially in terms of the foreigners and wanting to put liquidity in India. While there's a high interest on India, but the allocations currently are not very meaningful. If we have essentially the outcome of the next election out of the way and we have massive political stability for the next 5 years, I see massive introductions of policy changes which are going to act as strong tailwinds. It's going to turbocharge our economy further, and it's going to compel very large foreign investors to kind of come in and be invested into India. And so clearly, we are going to see a huge surge of liquidity coming in. So the outflows that we are seeing in recent months is going to convert into inflows. And I think probably between April to September, we received $20 billion, I think, of flows, which is annually $40 billion. Just imagine if that actually doubles and becomes $80 to $100 billion annually for the next 4 to 5 years, the kind of FDI that we could see if India is targeting more than $1 trillion of spending on infrastructure by 2030. So clearly over the next 4 to 5 years could be really the first phase or the trailer of the Amrit Kal that we all are longing to see over the next 20 to 25 years. So I think if these were things to happen, clearly over the next 4 to 5 years, I wouldn't be surprised if India ends up being one of the most outperforming public markets globally. I mean, we saw that with Japan in the 80s, and we've seen different countries of that kind. And it's quite possible, and we talk about this decade being India's decade. It's quite possible that in 27, 28, the timeframes that you alluded to, we could truly be cherishing India's decade.
Wonderful. And on this excellent, very bullish note, gentlemen, Sakshi and I would like to thank you for your valuable time, and more importantly, on the wonderful picture that you painted for the markets in the coming years and of course in the next Samvat. Thank you so much for your time, and once again, festive greetings to all their families and all your clients.
Thank you.
Thank you so much.
Thank you, sir. Thank you.
So that, ladies and gentlemen, was a very, very exciting Diwali special. You got to hear on how macroeconomics could actually change and bring in fabulous results for Indian markets. The ultimate lesson in all this is that should you see a good dip coming into Indian equities, this would be a right time to get back into the markets for the longer term. Invest wisely, invest in quality, buy for the longer term, and buy every month. Should you do that and remain invested for a long period of time, it's very, very difficult not to make supernormal money. With that, thank you so much. Sakshi and I thank you on behalf of our PCR team. Stay tuned to BTTV for more news and more about markets.